A little while back, I found myself in a situation that was both exciting and a bit overwhelming. I had just inherited $850,000 from a relative, which felt like a life-changing amount of money. It wasn't something I was expecting, and while I was incredibly grateful, I was also faced with some big decisions about what to do next. At the time, I was living in California, making around $100,000 a year. After taxes and my retirement contributions, I was bringing home about $65,000 annually. I owned a home, but I still had $500,000 left on my mortgage, which had an interest rate of 3.75%. My monthly mortgage payment was $2,800, not including property taxes. When I first received the inheritance, I parked it in a high-yield savings account HISA that was offering a 4.4% annual interest rate. That felt like a safe place to keep the money while I figured out what to do. But I quickly realized that I needed to make some decisions. Should I use the money to pay off my mortgage entirely, or should I invest it and try to grow it over time? I started doing some math to help me make my decision. Since the interest I was earning in the HISA would be taxed, and I figured my tax rate was about 30%, I realized that I would need to earn around 5.5% on investments just to break even with the 3.75% interest I was paying on my mortgage. That was my first big realization. Just because my savings account was earning 4.4% didn't mean I was actually keeping all of that money. Once taxes were factored in, the effective rate was lower, and suddenly, paying off the mortgage seemed more appealing. But there was more to consider than just the math. Paying off the mortgage would mean I'd be debt-free, and that was a huge draw. Not having a mortgage payment would free up to $1,800 a month in cash flow, which I could then use for other things like saving, investing, or just enjoying life a little more. Plus, the idea of owning my home outright, with no debt hanging over my head, was incredibly appealing. It felt like a way to simplify my financial life and reduce my stress. On the other hand, paying off the mortgage meant that a big chunk of the inheritance would be gone, tied up in my house. While that would be a good thing in terms of having a debt-free home, it would also mean that I wouldn't have as much liquidity. If an emergency came up, or if I wanted to take advantage of a great investment opportunity, I wouldn't have as much cash on hand. That made me think twice about whether paying off the mortgage was the best move, so I started thinking about other options. I'm pretty risk-averse, so I wasn't keen on putting the money into the stock market, especially since it can be so volatile. But I also didn't want to just leave the money in the HISA indefinitely, earning a relatively low return after taxes. I wanted to find a balance between safety and growth. One option I considered was paying off a portion of the mortgage, maybe to $150,000, while keeping the rest invested in a mix of conservative assets, like bonds or a diversified portfolio of index funds. This would reduce my monthly mortgage payment, giving me more cash flow, while also keeping some of the inheritance invested and growing over time. It seemed like a middle ground approach that could offer both security and the potential for some growth. Another idea was to keep the mortgage as is, and instead focus on building a diverse investment portfolio with the entire inheritance. I knew that historically, the stock market has offered higher returns than what I was paying in mortgage interest, but again, I was wary of the risk. However, by diversifying across different types of investments like stocks, bonds, and real estate investment trusts (REITs), I could potentially achieve a balanced portfolio that offered growth with less risk. As I weighed these options, I also thought about my long-term financial goals. Did I want to retire early? Was I planning to move in the future? What kind of lifestyle did I want? These questions were important because they helped me think about how this inheritance could fit into my broader financial picture, not just my immediate needs. After a lot of consideration, I decided to take a hybrid approach. I paid off $150,000 of the mortgage, which reduced my monthly payment and gave me some peace of mind. With the remaining $600,000, I created a diversified investment portfolio that was aligned with my risk tolerance. I included a mix of low-cost index funds, some bonds for stability, and a smaller portion in REITs to give me some exposure to real estate outside of my primary home. I also kept a portion in the HISA as an emergency fund. This approach felt right for me. It reduced my debt, increased my cash flow, and still allowed me to grow the remaining inheritance over time. It wasn't a one-size-fits-all solution, but it worked for my situation and my comfort level with risk. Looking back, I'm glad I took the time to think through all the options rather than rushing into a decision. It reminded me that personal finance is just that personal. There isn't always a clear right or wrong answer, but rather a range of options that can be tailored to fit your life and goals. If you find yourself in a similar situation, I'd recommend taking the time to evaluate all your options, considering both the numbers and your personal circumstances. And remember, it's okay to take a balanced approach that doesn't lock you into one extreme or the other. In the end, the most important thing was that I made a decision that felt right for me and my future. I'm not a financial advisor, but I've learned that being thoughtful and deliberate with your money, especially when it comes to big decisions like this, can lead to a lot of peace of mind. Thanks for watching. Subscribe Money Island for more new personal finance stories.